Today we're with Josh from MAB New Homes, who we work with as one of our panel of financial advisors to support people looking for a mortgage for a new home. And he's going to talk us all through the process of getting a mortgage and understanding your affordability and finances when it comes to buying a new build home. So Josh, one of the first things that we probably need to think about is, how do you know in the first place you can actually afford the new home that you're looking at?
Yes, a great question. So obviously there's various different ways that you can actually look on terms of the affordability side. So lenders will obviously take into account what your income is. So that's one of the main factors. The other bit is your outgoings as well. So if you've obviously got some outgoings, that's going to have an impact on your overall affordability. Different lenders will work on different affordability. Some will give you enhanced affordability. It all comes down to what your actual income is, and also the loan to value as well, because that does have an impact. So if you're at 95% lending, so a 5% deposit, some lenders will not offer you as greater affordability than if you was a 10% deposit, so 90% lending, just because it's deemed high risk. So in terms of the affordability side, yes, obviously your income's quite a big factor in that, but also it works on your outgoings as well. So again, if you've got some commitments, that will have an impact on what your actual affordability is.
Mm-hmm. So I've heard, I don't know how true this is, that it's like 4 times your income is basically what you can afford to lend from a mortgage provider. What is the actual calculation that they use?
Yeah, so majority of lenders will typically look at 4.5 times what your income is. Some lenders will give enhancements on that. So if you're doing like 90% lending, some lenders can offer you 6 times what your income is. Sometimes there is some lenders that can do up to 7 times what your income is. So just in terms of that, again, typically it's 4.5 times, but it does vary lender to lender, and obviously what your actual household income is as well.
Yeah, and you said obviously like car finance, student loan, any kind of financial commitments come into it. So let's say, for example, I'm earning 42 grand, I've got a car on finance that's £250 a month. Like, what do I need to be looking at from a deposit point of view? What kind of affordability have I got?
Yeah, so if you're sort of looking, let's just say based on that situation, you've got a 10% deposit.
Okay.
So some lenders could offer you up to £230,000 as a general guide. So again, just slightly over what your 4.5 times income is as well. So obviously they are giving you a bit more enhancements on that. Again, a lot of it depends if you're first time buyers, if you're home movers, because again, some lenders will offer a little bit more affordability for first time buyers. Mm-hmm. So again, it just literally depends on what your circumstances are. But as a general guide, you're looking around about up to 230,000 or so, mm-hmm. depending on obviously which lender it is.
So we've talked about obviously income. What about if I'm self-employed? Because I know that people obviously mention that when they're self-employed, it's a bit of a struggle to get a mortgage compared to if you've got an employment contract. So yes. How does that kind of work with lenders?
So lenders, when you're self-employed, will look at your last 2 years trading.
Right.
So they'll look at your last 2 figures that's been declared. So some lenders will accept 1 year, but again, you are limited in terms of your options available on that. But working on the 2 years, so if you're, let's just say, a limited company, most lenders will work on the salary and dividends, mm-hmm. Which is obviously what you draw from the business. Some lenders will also look at your salary and share net profit. Mm-hmm. So again, if you keep quite a bit of money in the business, so you retain it in the business, then you will have a higher net profit. So some lenders will actually work on the salary and net profit. So again, if you speak to a broker, they can obviously look at your SA 302, they can also look at your company accounts, and they can work out exactly what we need to work out in terms of what your affordability is. If you're a sole trader, then lenders will typically look at your last 2 years net profit. Mm-hmm. Lenders will always look at the lower of the latest years or the average of last 2 years. Mm-hmm. So if you've earned a little bit more in your latest year, doesn't necessarily mean the lender will actually use that income, because they will typically look to average it over the last 2 years.
A lot of people are renting at the minute. Rental is going up, but you know, the rent itself is quite unstable. You can sometimes find that you pay more and more over the years. What would you say to someone who's kind of considering renting over purchasing a home because they're a little bit worried that they might not be able to afford that mortgage?
Yeah, so again, a lot of it's deposit. That's obviously one of the key factors. But if you've got the deposit available, or you're looking if that family potentially could help you out as well, it's probably a good time to buy. So obviously the main thing when you're renting is that each year your rent's likely to go up just because of inflation. So every year your payments could increase, whereas when you've got a mortgage, if you're fixed in, so let's just say you do a 5-year fixed rate, for your next 5 years, you know exactly what your payment is every single month. So your interest rate's not going to go up, your payment's not going to go up. So it gives you a bit of stability, so you know exactly what you're paying. Your mortgage is typically your most expensive bill you have each month. So you knowing what that payment is for that amount of time allows you to budget for everything else as well. So, and also you're building up equity in the property, so you're actually gaining something from that as well. When you're renting, obviously you're not seeing anything for it other than just a home, whereas obviously once you've got your own property, you know that obviously that property is yours, and also you know that you can be gaining equity in that property as well.
So when you talk about equity, that means that when they come to buy the next home, that money that they've kind of paid on the mortgage has built up as a value in the property, doesn't it? So then they'll sell their home, and that almost acts as part of the deposit for the next home. So it's obviously a worthwhile investment for the future, and property prices can increase, so the value of the investment can go up.
Yes, correct.
Brilliant. So what we're saying really is, ideally, if you can, you know, look at tapping up bank and mum and dad if you're struggling for a deposit, and try and get on that property ladder as soon as possible to start that investment journey.
Yes.
So Josh, there's obviously so many different terms and products and things in the mortgage market. It's a bit of a minefield. So what are they all like? What's a fixed and tracker and variable? What do all these things mean?
Yeah, so a fixed rate gives you the security for that period of time. So if you do, let's just say a 5-year fixed rate, for that 5-year period, you're tied in. So if the interest rates come up, if they go up, they come down, you're tied in at that deal that you've already secured. So it can work in your favour, it can also work sometimes against you as well if interest rates come down. But the fixed rate basically means that during that fixed period of time, your interest rate's not going to change, so it allows you to budget for everything else going forward. The tracker rates track the Bank of England base rate. So if, for example, the Bank of England base rate is at 3.75%, then a lender could offer you so much percentage above that. So if that interest rate from the Bank of England increases, so does your interest rate. Likewise, if the Bank of England base rate reduces the rates, so does your rate as well. So you'll stay so much above what the Bank of England base rate is set at. You've got the variable rate, which is set by the lenders. So the lenders will have their own standard variable rate, and again, depending on the market, they can look to increase that or decrease that as well. And then some lenders will offer something called a discount, which is very similar to what a variable rate is. The only thing is with the discount is that you are paying a little bit less. So a lender, just an example, may offer you a 1% discount, so in which case you'll pay 1% below what their standard variable rate is.
Right, okay. And you hear sort of the term loan to value banded around a lot in terms of mortgages. What does that mean? So
loan to value is effectively the loan against what the value of the property is. So again, just an example, your property may be worth £200,000, and if you're doing 10% deposit, so you're doing obviously 20,000, your mortgage is 180, so you basically classed it at 90% loan to value. So the higher the loan to value, the interest rates are typically a little bit higher, just because it's deemed high risk to a lender.
Okay. So if you went for like if you could put a 20 or 30% deposit down, you might get better interest rates because you'd be on a lower loan to value.
Yes,
right,
correct.
That makes sense. And when we talk about interest, it's usually percentage APR, isn't it? So what does that mean?
That is just literally the total cost of what your mortgage will be.
Okay. So it's just a percentage of the overall cost.
Correct.
Does that change year on year then? Does it go down?
It depends on what deal you've got. So if you've got a fixed rate, then obviously you are tied in for that period of time. So yeah, it's basically calculated as per what your interest rate is.
Right, I get you. And when it comes to sort of deciding how long to take the mortgage over, I know like some people do it over 20, 25 years, some do it as long as 35 or 40 years.
Yes.
How do you work out what's the best? Should you go short term or long term?
It's very much down to the customer in terms of what they're looking to do, what their circumstances are, because every single person's circumstances is slightly different. What I would sort of say to people is that you ideally want to do it as short as possible, but also affordable to you as well. You don't want to be in your lovely new home, but you can't afford to do anything else. So I would also sort of say that ideally you want to go as short as possible, but also affordable for you. The advantage with going shorter is that you'll pay less interest because it's over a shorter period of time, but your payments will be higher because obviously you're doing the mortgage shorter. If you do a longer term, then your payments will be cheaper, but you will pay more interest because you're taking it over a longer period of time.
Yeah, brilliant. And what about if you needed to, for whatever reason, pay that mortgage back early? What would happen then?
So lenders will have something called an early repayment charge. So it all depends on the deal that you've currently got. So I would always sort of say speak to your broker and obviously can try and give you better advice on that. But an early repayment charge is if you need to get out of the mortgage early. So if you're within your fixed rate period, or if you've got a tracker rate or a discount rate where you're tied in, then if you need to get out of that deal early, you'll have something called an early repayment charge. So if you're looking to move, some lenders will have a portable mortgage. So again, double check what your terms and conditions are. But if your mortgage is portable, that means that subject to meeting the affordability and criteria with your existing lender, you can take the mortgage with you to your property, and then you potentially don't have to pay any penalties. Again, a lot of it just depends on the amount that you're borrowing. So if your borrowing is going to actually come down, you'll pay the penalty on the difference that you reduce your mortgage by. So I would always sort of say that speak to your advisor, and they'll be able to give you the best advice on that.
Brilliant. So when it comes to buying a house, obviously you need a certain amount of deposit percentage, but what is the sort of minimum deposit that you would really need?
So when you're looking to buy a new build property, you're going to need at least a 5% deposit. Obviously that is subject to affordability as well. So again, sometimes you might need slightly more deposit depending on what your affordability allows you to borrow at. But yeah, typically you need at least a 5% deposit.
So that's 5% of the house value,
Correct,
isn't it?
yes.
Well, and what kind of impact does it make if you have 5%, 10%, 15%, however much percent you can afford? Like, how's that going to impact you? So
the more deposit you get, the potential better the interest rate you're going to get. So if you're doing a 5% deposit, so you're looking to borrow a 95% loan to value, that will mean you'll be on a higher interest rate compared to if you can do a 10% deposit, because it's deemed high risk from a lending point of view. So from that side of things, yeah, the more deposit you can get together, ultimately the better, because you're potentially going to get a lower interest rate. So yeah, if you've got a 5% deposit compared to 15% deposit, 15% is going to be cheaper for you, but also your interest rate is going to be lower.
Yeah. And what about if, for example, Bank of Mum and Dad are giving you your deposit as your first home, or maybe you're getting some inheritance or something from a family member a little bit early? What would happen then? How do you need to work that?
So from a gifted deposit point of view, lenders will accept that. So they will accept a gifted deposit. Lenders vary lender to lender, so some lenders will ask for more information than some other lenders, but ultimately it is acceptable. Some lenders will restrict you in terms of the source of that though. So if you're, for example, getting a gift from a friend, then that will limit you, because not all lenders will accept a gift from a friend. So yeah, all I would sort of say that you need to do is that when you're looking at getting a gifted deposit, make sure that when you speak to your advisor that you are disclosing the source of that, because that will obviously impact which lenders we can check on your affordability. So yeah, if you're getting a gifted deposit, it is acceptable, but just make sure you're disclosing where that's coming from, because ultimately we need to make sure that we're recommending you the correct product.
And what about if you are not buying your first home, so you've got a house to sell and you've got some equity that you've already built up in that property? How does that work toward your deposit? Do you need a deposit still for your new house? Like, how does it work from a loan to value point of view?
Yeah, so you'll still need a deposit, but you can use the equity as the deposit.
Okay.
So again, let's just say you've got £50,000 equity in your property at the minute, and you want to put down the £50,000 for your new property, then yeah, that's what your deposit will be. So you don't need to have any additional funds and savings to be able to put down, so you can use your equity, and you don't even need to use the equity. So if you want to keep some money back for your stamp duty or legal fees that you'll have to pay, then ultimately you could keep some of that equity back as well. But yeah, you can use your equities to fund your deposit.
Well, and that equity builds up over time when you're paying your mortgage, doesn't it? So that's the money that you're paid off. So when you were renting, you wouldn't be getting that money back, but when you're buying a home, that goes into kind of investing in your property. So it builds up the deposit for the next house, I guess. Yeah,
so when you've got your equity in your property, so again, just use an example, you got the 50,000, let's just say you put a deposit down of £50,000 initially. Obviously over time your mortgage value is going to come down, but your valuation of the property in hindsight should increase a little bit just because of inflation. So you obviously gain equity because you're paying your mortgage off, but you also gain equity if the house increases in value as well. So yeah, that is effectively what your own money is.
So what kind of costs do you need to think about when you're moving home then?
So there's a few different costs that you're going to have. So you've got your deposit that you need to find to pay that up front. By exchange of contracts, you need your deposit. You can have stamp duty. So depending on your situation, especially if you're a second time buyer, you may have stamp duty to pay. From a stamp duty point of view, there's various calculations you can do online to double check the exact amount, or I would recommend that you speak to a solicitor because they'll be able to give you the advice for that. You're potentially going to have a survey fee depending on the lender that you use. So from a new build point of view, because you do get your warranty, so from that side of things, you probably look at a standard valuation anyway. But again, your advisor will advise you best on that. Some lenders, like I said, will potentially charge you a fee for that. A lot of lenders also do have a free valuation. So again, that would differ from lender to lender. Some lenders also charge product fees. So you may have a product fee to pay up front. Again, some lenders will allow you to add that onto the mortgage. That sort of limits depending on the loan to value, your affordability. So again, your broker will be able to advise you on that as well, what the best option is for you. You're also going to have your solicitor fees to pay. So your solicitor fees will be dependent on your circumstances as well. So from the solicitor side, you could be looking anywhere from sort of £1,000, £2,000. Again, if you're looking to move, you may have the selling and buying as well. So again, extra fees on top of that. If you're getting like a gifted deposits, the solicitors will charge you slightly more for that as well. Okay. So again, a lot of that will just depend on your circumstances. So from the legal fee side, Strata will recommend someone for you to speak to. So they'll recommend a panel of solicitors, have a conversation with them. They'll be able to give you some ideas of costings on that.
Yeah.
You're also going to have your moving costs. So when you're looking to move house, you've also potentially going to have removals to pay, so storage costs depending obviously your circumstances as well, and ultimately a lot of builders do offer extras on the property as well. So again, it just depends on that.
Yeah, that's a really good point. I mean, if you're obviously moving from either a rented property or this isn't your first home, you're probably going to have furniture and things that you're going to want to bring with you. But I suppose one of the benefits of new build is that they come with things like optional extras like built-in wardrobes, so you don't need to move your wardrobes. You've got your brand new kitchen and your bathroom, so I suppose that's not a cost that you're going to have to factor in, which you would if you were buying a second-hand property. And also there's things like your part exchange schemes or your help to move that we offer at Strata, where it is taking away that fee of having to pay an estate agent to sell your existing property if you are moving into your next house. So yeah, really good point. So let's say that someone's come and they fell in love with a Strata home. What is the process then when they need to sort of find out if they can afford it before they can reserve?
So the initial call that we'll do with a customer is just to qualify them, so make sure that they're past the affordability based on all the information that's been provided to us. So we'll double check it with a lender to make sure that they are able to get the affordability required. We'll also look to do a decision in principle to make sure that you're passing the credit check as well, because we want to make sure that you're not just about your affordability, but your credit score is enough to be able to get that particular mortgage that you're looking at.
Yeah.
So we'd look to do a credit check at that stage just to make sure that you're passing what you need to pass in order to reserve a property with Strata.
So then your decision in principle, they could bring that to us or whoever their home builder is and say, I'm ready to reserve now. We'd then take their reservation fee. At what point do they then need to actually put the official mortgage application in, and what kind of information do they need to be able to go forward with it?
Yeah, so once you've reserved, I would say you need to get in touch with your broker just to make sure that you obviously made them aware that you've reserved. The broker will then get in contact with the customer to sort of provide what information is going to be required. So you'll typically need your proof of ID. So you could be looking at passport and driving license if you've got both. Proof of address, you're also going to need to have last 3 months bank statements, last 3 months pay slips, or if you're self-employed, you're going to be looking at the last 2 years SA32s and tax year overviews, and also company accounts as well. And then also you're going to need your proof of deposit as well. So again, that's what we would need to satisfy what a lender is looking for.
And if that deposit was gifted, what kind of information would you need?
So from a gifted deposit, we need a letter from the donor just to confirm that they're happy that they are gifting that amount of deposit, and they'll also sign that to confirm that. And then we'd also require 3 months bank statements from the donor just to confirm that we've obviously got the funds there as well. And again, just to satisfy lender's requirements.
Yeah. So once the application for the mortgage has been put in, what's the next steps?
So once the application has been put in, the lender will ask for an initial set of documents. So the broker will upload the documents that's obviously being requested, and then what would happen then is the valuation will be booked in. So the valuation will be panelled, so each lender uses different valuers. So some will have just one valuer that they look at, some will have a panel. So the lender will instruct the survey to be booked in. That will then be booked in between the valuer and also the developer. So site will obviously be in touch with them as well, and they'll arrange a suitable date for both parties to get the valuation booked in.
And then after valuation, can I then expect an offer?
Yeah, so once everything's been agreed by the lender, so they're satisfied with all the documentation, they're satisfied with the valuation, your mortgage offer will then be issued. So different lenders have different offers. So some lenders will give you a 6-month offer, some lenders will allow you to extend for a further 6 months using the same interest rate as well. So again, quite important for you, because if interest rates are rising, you want to make sure that you're going to have that valid mortgage offer for your sort of build date as well. So yeah, from that side, that's part of our recommendation, to make sure that your offer will be valid based on what your expected completion date is.
Yeah. And then next, I think, comes exchange of contracts. Is that right?
Yeah, so once you've got your mortgage offer, your solicitor will be in touch with you. They will then start doing everything they need to do legally. And then what will happen is you'll get to the stage where you will be exchanging contracts, and that's typically where you'll pay your deposit.
And then on completion day, what happens? How does the mortgage lender get the funds?
So on completion, your solicitor will be requesting funds from the lender. The lender will obviously send that over. As soon as the solicitor's got the funds, you can obviously confirm that you're ready to go in terms of completing. Once you've completed, that's when you get the keys to the property. And yeah, so nice smooth process.
So when it comes to kind of considering whether to buy a second hand versus a new build property, obviously there's a lot of benefits from the point of view of a builder can offer great deals on incentives, they can offer you upgrades, deposit contributions are obviously going to help from a financial point of view. Is there anything that is beneficial from a mortgage point of view, like is the specific mortgages that are just for new builds or anything like that?
Yeah, so when it comes to new build, a lot of lenders will look at the energy performance, so the EPC rating. So what lenders will look for is that if it is classed as energy efficient, so if it's got an A or a B rating, a lot of lenders can look to either do a bit of cash back, you might get slightly better interest rates. Some lenders will also do enhanced affordability, so because your bills are typically a little bit lower than what it would be from a second-hand property, so an older property, they will look to give you enhanced affordability because your outgoings are going to be a little bit lower, so they'll look to try and increase your affordability a little bit as well. So from a new build point of view, it potentially could get you a bit more affordability because your bills are obviously lower.
And I suppose there's also the fact that, you know, stamp duty and legal fees can sometimes be negotiated from a new builder. And yeah, there's also lots and lots that we can offer as incentives. So yeah, definitely a good reason to buy a new build.
Yeah.
For a first time buyer, I'm sure that you see a lot of mistakes being made. So what are some of the most common ones and what can people do to avoid them?
Yeah, so one of the first ones that we typically see is people not speaking to a financial advisor.
Yeah.
So you might see a lot of people that might just go on the internet and just get any sort of decision in principle, but you've not received any advice for that. You do see it a lot where people get variable income. So a lot of people will just lump the income all as one, but if you get quite a bit of overtime, lenders don't always take 100% of overtime. So your actual true affordability could be a little bit less than what you think. So I would always sort of say the first thing is to speak to a financial advisor so you can sort of understand what your affordability is, and obviously you know what your borrowing requirements are then. One of the next ones we see is changing jobs during the application. So obviously changing jobs during the application, if you obviously have to make us aware of any changes and it's listed in all your documentation you get from the lender. So if you change your job during the application, lenders will initially sort of look to withdraw the offer because obviously there's been a change of circumstances. So it could be that even if your income's gone up, lenders have different requirements. So it might be that we need your first pay slip. So different lenders will have different requirements regarding changing your job during the application. So
I suppose as well, like if you're in a probation period or you don't know that you might get on, you might start that new job and hate it and want to leave straight away. So I suppose there's a bit of job security issue there as well. Yeah,
so like I said, I would always sort of say before you do anything in terms of accepting any jobs is speak to your financial advisor and just see how that is going to impact you as well. You also see people taking out additional finance. So a lot of people always ask once they've got the mortgage offer, can I take a sofa on finance? So I would always sort of say to people that before you do anything, you just speak to your advisor. They'll be able to tell you what you sort of can and can't do and the risks that are involved. Even if you feel that it's within your affordability and it is affordable for you to do so, you've just got to be really mindful, because one of the other considerations is your actual credit score. So when you take out some additional finance, your credit score potentially could be impacted a little bit, so it might reduce your score a little bit. So if a lender wanted to redo a credit check on you, because they can do up until completion, you potentially may be out of their scoring requirements, and then they could withdraw the offer from you. So I would also always sort of feel that if you are looking to take out any additional finance, before you do anything, just speak to your financial advisor. They'll be able to say exactly what you can do, but also explain what the risks are involved as well.
Does that even go for if you were to get something where it's like just putting a soft check on your credit score, on your credit file? Would you try to avoid that while you're in the mortgage application process? Yeah,
soft credit check shouldn't impact you anyway. But when you are applying for finance, so if you decide, I want to take that sofa out, then ultimately they will do a hard credit check on you. So like I said, the last thing you want to do is have hard credit checks done, because over a short period of time it can impact your credit score quite a bit. So yeah, I would always sort of say that if you want to do anything like changing jobs, taking out additional credit, I would always sort of say speak to your financial advisor.
No new cars, no credit cards.
Unfortunately,
no splurges until after the completion.
And then the sort of other thing is actually looking at people's budget and what they can afford. So what we will do is we'll do a budget planning with a customer, just to make sure that they feel that they can afford it, so they can sort of list what their outgoings are going to be, or estimated outgoings are going to be when they move into the property. So again, it gives them a good idea that yes, with my mortgage plus all my outgoings, it is affordable for me as well.
So would that take into account things like your estimated council tax, your management fees, which we obviously provide when you're looking at a Strata home, but also maybe like your estimated bills and things like that for living in that house? Making sure that basically it's not just the mortgage, but you can actually afford the running costs of the home too. Yeah,
that's it. That's the main thing, is it's not just about getting the home, but you need to make sure you can afford all the other bills that come with that as well.
Yeah, that's really sensible. What would you say to someone who's maybe considering downsizing for whatever reason, whether it's relocating to be closer to family who've moved further away, kids have moved out, gone to university, and they've got that kind of all that space, and they're thinking they might want to sort of have a bit of a fresh start somewhere else? What would you recommend? What are the considerations that they need to think about?
Yeah, so obviously when they're downsizing, if you've got a mortgage currently, so if you're looking to clear that mortgage, you might want to take a big chunk out of the mortgage, then you potentially got penalties to pay. So that's just one thing to sort of consider initially. You might want to just do it because you generally want to release some equity in the property, so you don't need that much space anyway. So you might think that we've got a bit of money to live on for retirement. You might want to give it to children, grandchildren, to help them get onto the property ladder as well. Stamp duty is obviously another thing, because obviously you will have stamp duty when you buy the new property anyway. So that's something that you want to factor in and consider as well. And then sort of one of the other things that you probably want to look at when downsizing and a positive is when you're buying a new build property, it's going to be energy efficient. So you can have lower bills, you can have low maintenance, which is potentially one of the reasons why you want to downsize as well. So I think when you're downsizing, there is a lot of positive to buy a new build property.
Yeah. So when you come to buy a new build home, if you've already got an existing home, so you might be buying your next house on the property ladder, we'd ideally want you to be sold subject to contract. Obviously, we offer things like part exchange or help to move, so we can help them with that. But when it comes to helping them with an existing mortgage, what do they need to consider?
Yeah, so if you've got an existing mortgage, one of the things we can look at is obviously porting it. So this will be in your terms and conditions of your existing mortgage that you've got. But yeah, one of the things you can do is look to port it across. So that basically means you'll take your current mortgage amount to your new property, keep your interest rate as well, subject to terms and conditions with your lender, but you'll keep your existing mortgage and interest rate with that existing lender. And then if you need to do any additional borrowing, all you'll do is you have a second part of your mortgage where you'll borrow the extra bit of money you need on an interest rate that's available at that time. So you'll have two different interest rates, two different mortgages if you are porting it. What we would look to do is look at two options for you. So we would look at porting the mortgage, but we'd also look at paying your early repayment charge and taking out a brand new mortgage. So that can depend on how much your early repayment charge is. It could also be if you're on a quite high interest rate at the minute. So there's a lot of different considerations to factor in. But again, speaking to a financial advisor, they can obviously explore the options that's available for you. So at least you can see what is your best option going forward, just in terms of that.
And what about your deposit? So where does your deposit come from if you're buying your second property?
So from a deposit point of view, a lot of people will look to use the equity. So again, everyone's circumstances are slightly different, but you could be looking to use your equity that's within your property. You might decide that you want to keep a little bit of equity back to fund stamp duty, legal fees, moving costs. You might have some additional savings to put down on top of that. So again, it would be more down to what your affordability allows, but also what your preference is as well. You might not have the additional funds to be able to pay for stamp duty. So you might decide to put down a little bit less deposit, so keep some equity back to fund that, which obviously would be paid on completion. So yeah, you could obviously look to use additional savings if also required.
Okay. And what if my house hasn't sold and I really don't want to lose out on this property? What are my options from a mortgage point of view?
So there's a couple of options. You've obviously got a bridging loan. The only thing with the bridging loan is it can be quite expensive. Yeah. One of the other options you could do is look at having it as a second mortgage. So if affordability allows, you could look to keep your existing mortgage in place and then look to purchase the new one. Obviously, you would need your deposit available, so you will need a bit of savings. But if that's affordable, all the lender would do is factor your existing mortgage into the affordability calculation. If it all passes affordability, then you technically don't need to have sold. You could obviously do it like as a second home. The only thing is you will have is obviously additional costs in terms of stamp duty, etc. But again, a solicitor would obviously explain the implications of that as well.
Mm-hmm. We've had some questions through from people who are in the mortgage process or looking to buy a house at the minute who have a few questions. So the top question we've been asked is, how long does a mortgage application take?
So a mortgage application can vary depending on lender, how complex it is. So if it's self-employed, it can take sometimes a little bit longer. In terms of application to offer, I always sort of say around a couple of weeks. One of the main aspects of it is the valuation. So sometimes a valuation could be booked in within 24 hours, it could be a couple of weeks. So it just depends on obviously availability for the site, but also the valuer that it's being panelled to. In terms of the full process, depending on the solicitor as well, but you could look to complete from application to completion and getting your keys within 4 to 6 weeks. Again, a lot of that would depend on time frames, but all different lenders have different time scales. So again, it would just be making sure that we can obviously meet that time scale if required. But generally from application to offer, I would say an average a couple of weeks.
Mm-hmm. What kind of credit score do you need if you had to put a number on it?
So you don't necessarily need to have a certain number in terms of what your credit score is. Different lenders have different internal systems where they sort of do the credit scoring and how it's calculated. If you've got sort of a low score, but it's not necessarily due to issues with credit, it could just be you've not had credit. Yeah. There is some lenders, if you aren't sort of meeting what standard credit scoring is, some lenders will actually, rather than credit scoring, you will credit check you. So they'll actually look at your credit report rather than actually doing a check on you, letting a computer make a decision for you. So from that side, there's no sort of score that is required. It just depends on what your circumstances are, and obviously we can obviously help you with that as well.
Can I buy with bad credit?
Yes, to a certain degree. Obviously it depends on what the issues are. A lot of that will determine on what the credit has been. So it could be CCJ, it could be a default. A lot of it's on amount. It also depends on how recent it was, if it's satisfied, not satisfied. So again, the answer is yes, but it would depend on what credit you've had and how recent it's been. But again, I would just sort of say speak to your advisor, get a copy of your credit report to your advisor, and we can obviously give you the advice then. Mm-hmm.
Last one is, should I overpay my mortgage?
Yes, if it's affordable to do so. So obviously the quicker you pay your mortgage off, you're going to be mortgage free quicker, but you also pay less interest. So in the ideal world, you do want to make overpayments if it's affordable. One thing I would say is just be careful, because lenders have overpayments or limits. So majority use 10%. There is some that do 20, but majority is 10%. So before you make any other payments, I would sort of recommend just double checking with your lender to make sure you're not going to be charged any other repayment charges. So
thank you so much, Josh, for today. And if anybody has got any questions or wants any advice, could definitely recommend MAB New Homes. Get in touch and they will give you advice on mortgages for new build homes or second hand homes. We'll put their details below.